Hello and welcome to the January 2026 quarterly Q&A with the advisors at Owens Estate and Wealth. My name is Sonia Jenkins. I'm a partner here at the firm, and I'm joined with Peter Ketchand, head of investment committee and a partner here, as well as Dylan Blomgren, financial advisor and a partner as well. We're thankful that you're joining us today. We want to do a little bit of an economic and market update for you. And so with that, I'm going to dive right into the content. I kind of always want to start off with an economic recession dashboard update of how are we doing relative to recent history. And I find this slide to be very helpful because it kind of shows us how the economy has done over the previous 3 quarters. Now, you'll notice in the current quarter, there are a few items that are missing their information because of the government shutdown that occurred in October of 2025. But if you kind of look back at them, everything stays pretty well in line with September of 2025, with the exception of ISM new orders. That has moved from a cautionary position into a recessionary position. But conversely, the yield curve has moved from a cautionary position into an expansionary position. So those kind of have an offsetting as far as looking down the column of how are we doing overall. Housing permits, they were in a cautionary position in September of 25. We don't have all of the data yet for the 4th quarter of this year, but what we do have posted so far pretty well alludes to the assumption that we're going to see it remain in a cautionary flagging position. I don't expect it to move to either recessionary or expansion, but we'll find out when the numbers finally are released later this year. Retail sales, again, we have some of the information that's been released for the month of November. The final reads were posted. Those were still expanding, so our expectation is that's going to stay in an expansionary position. So all of that to say, looking at the overall signal of the economy as a whole, we still remain in an expansionary economy. Now, we've talked about over time how starting back in 2022, we saw all of the economic indicators move into a recessionary position at one point or another, with the exception of the labor market. And that has kind of kept us out of formally declaring a recession. Now, when you look at this graph, I think this is pretty interesting, that in a maturing economic expansion, we usually see accelerating wage pressure that drives a tightening bias for the Federal Reserve. Now, right now, we're seeing wage growth inflation go down, right? We're seeing less pressure on wage growth, and that's actually indicative of an expanding economy. So giving some tailwinds to that position of the labor market. If you kind of push that forward and look at the labor market dynamics, well, we're definitely seeing a trend down in the non-farm payroll gains relative to the peaks in 2021 and 2022. When you look at the unemployment rate and the annual wage growth rates relative to their historical norms, we're still either below historical unemployment rates or above wage growth rates. So those continue to play well in the labor and job market environment. Labor demand, looking at the demand for jobs, we kind of have this anomaly peak in 21 and 22 coming out of the COVID era, where we have kind of this outlier of an outcropping of figures. But if you draw a trend line from 1973 forward, you can kind of see that labor demand is kind of staying on trend. It's not wildly off the mark, even though we've definitely come down from the peaks of just a few years ago. Hiring as well as layoffs continue to stay relatively within the historical norm, not wildly off their historical rates. So again, kind of keeping us in a comfortable labor market, not moving wildly outside of the historical norms. So when you look at that and the labor market relative to the economy, you kind of look at, well, if people are still staying well employed, wage growth inflation is staying above traditional inflation, and our GDP is historically largely driven by consumption. You can see by this chart and the contributors to real GDP growth, consumption is 68% of our GDP. And when we continue to stay relatively well employed with our wages staying up with inflation, we have more discretionary income to chase after consumption, and that bodes well for our GDP component. And so that's kind of just a high level look of how is the economy as a whole doing, really kind of focusing on the labor market because that seems to be kind of top of mind. One thing I didn't touch on when we were looking at the dashboard is job sentiment. And sentiment still is in a recessionary position. That's how corporations are feeling about hiring. It doesn't necessarily play forward to our actual hiring components. So it'll be interesting to see as we move into future quarters, does that true sentiment, how we're feeling about the job market, move into a different position? So with that, I'm going to pass the baton to Peter so that he can give you a deeper dive into inflation and interest rates and how they are impacting the economy.
All right, so the first slide we have here is the tariff slide. As you can see, the current headline rate is still 15.6%. And so, there's been a lot of back and forth on tariffs. And with that, the idea is that, tariffs really haven't done anything. And I would say we haven't really seen the true impact of the headline rate of tariffs because the effective rate, as you can see from the top of the slide for 2025, was 6.7%, which is higher, but not a lot higher than it was prior to Trump coming in. So the real question is going forward for inflation and the impact to the economy is that are we going to move towards that headline rate of 15%? Are we just going to kind of have 11.2%, which is the highest monthly rate on there? In which case we'd probably see a little bit more impact from tariffs. Or are we going to continue to see an effective rate that's a little bit lower? So the number is big, but the impact is not as high because eventually tariffs will create inflationary pressure. The other thing is that has been mostly out there, mostly documented, is that for now companies are taking some of the impact of that from the consumer, but that can't continue on a year-over-year basis. The other inflationary potential here is from the higher tax refunds from the big beautiful bill. As you can see from this, even though the top income bracket has much larger wealth accumulated than the bottom four brackets, they all pretty much spend most of their income. And even that top bracket, which is able to save a little more, still spends 4/5 of their what they bring in. And so with that, as we know from 2020 and all the stimulus, when you get that stimulus that goes into people's bank accounts across the entire economy, there will be more spending. So more spending chasing the same goods and services can be inflationary. It often is inflationary. Even if something like that happens, we wouldn't expect it to be that huge hill like we saw in 21, 22, 23. However, it would then put pressure on the Fed in terms of lowering rates. We would see economic impact concern and probably also effect on risk assets as the markets become once again concerned with higher inflation levels. With that being said, our economy is generally, as Sonia noted, doing fine. And generally an economy that's doing fine and growing at a trend line rate, close to trend, supports risk assets and supports capital markets. And so as we can see here from the consumer finances slide, that the consumer on average is doing fine in terms of their assets relative to their liabilities, is doing fine in terms of their ability to make money and service their debt, and is returning to trend in terms of people being delinquent and if they owe debt across cars or houses or things like that. The one thing you see that kind of stands out is the student debt, which again, there's been a lot of back and forth on that, and that will take some time before we can tell one way or the other. But one of the things that is important is not just how people are doing in reality, but how they feel about it. Much like job sentiment is important, so is consumer sentiment. So when we look at this slide, we see the consumer sentiment is low. The question is, will consumer sentiment go up or down? Because if consumers keep having a lower and lower sentiment, that tends to be bad for the economy and also risk assets, capital markets. But if we're seeing a bottom in consumer sentiment and consumer sentiment rallies, then at that point, markets historically have also done quite well. The other thing here, so we've talked about inflation. Inflation could be a tailwind, especially if it negatively affects consumer sentiment. However, if we don't see a lot of inflation and we see the interest rates stabilize where they are, we think that's generally positive as well. The Fed funds rate in between 3 and 4 would be historically a good place to be. It would be good for people who have money and who are saving and who are looking for those interest payments. And realistically, it would also be good for people that want to borrow money. So if rates go too high, it puts a stop on borrowing. But a lot of the consumer spending that's going on out there is among people 55 and over, and they've definitely benefited from those higher interest rates on their assets, on their ability to get higher interest payments from money market funds as well as bonds and things like that. And finally, we have one more interest rate slide, which shows that the interest rates are over inflation, which means you get real return for investing your money into debt instruments. And that is also a beneficial place to be, because you're not just keeping up with inflation, you're actually, getting return over inflation. And again, we like to see that condition when we're looking at asset allocations. In this next slide on the federal finances, we look at some of the things that could potentially be longer term tailwinds. Generally, we look at the deficit, which if we look at the projections is not going down, it's not going up, but it's already high. So high yearly deficits translate into growing total debt, which we can see in the federal net debt as it grows out into the 2030s. And again, we often talk about how those deficits can become unsustainable over time. It becomes quite difficult to reduce that deficit when we look at governmental spending versus the amount coming in. Additionally, much of that governmental spending that's supported by that deficit spending goes to consumers, which also supports the economy. So in this situation, we're in a very difficult place when it comes to making a choice between reducing deficits and, the long-term issues involved with our growing debt load. With that, I will hand it off to Dylan, and he will go a bit into the current market environment.
Thank you, Peter. The topic I want to focus on with all of you is artificial intelligence, and are we in an AI bubble? In the slide, we take a look back at previous bubbles in the Nifty 50 in the 70s and the dot-com burst in early 2000. In both of these circumstances, the price-to-earnings ratios were higher than we're currently at, and we were in a different rate environment. So back in 1972, with the Nifty 50, the price-to-earnings ratio was at 35 times earnings, and in 2000, with the dot-com darlings, they were at 75 times earnings. In both of those circumstances, the previous 12 months, we were in a rising interest rate environment. In 1972, the rates had raised by 2.1%, and in March of 2000, the previous 12 months, rates had raised by 1.3%. Currently, with the Magnificent Seven, the rates are negative 0.8% in the previous 12 months, and the price-to-earnings ratio is actually at 53 times earnings, but if we were to take out just Tesla, it would drop down to 27 times earnings. Clearly, we are not where we were in the dot-com bubble. Right now, we have higher profitability at 33% compared to 20% in March of 2000, and we are at lower valuations at 25 times earnings compared to 51 times earnings in March of 2000. All right, I find this slide extremely fascinating. We have the capital expenditure of major innovative technologies in the US and the peak historical investment of those innovative technologies. We have the railroads in the late 1800s. We have the telecom in the 1990s. And then we have the automotive innovations of the early 1900s. In all of those circumstances, the peak historical investment of those innovative technologies went well above 2% of GDP. And in the peak of the railroads, it was over 3% of GDP. Right now, we're currently at less than 1% for the AI expansion. So that shows us that we have quite a bit of room to grow before we get anywhere near what we've seen in the past. So this is showing the implementation of artificial intelligence across several different sectors. I don't need to break it down sector by sector. I want to focus here on the total average. And the average here is only at 17%. So once again, we still have quite a bit of room to grow with AI, and I don't see us being anywhere near above. Now this slide shows the companies that have the lowest adoption for artificial intelligence actually have the highest change in unemployment over the previous 12 months. Companies with higher adoption into artificial intelligence have a lower change in unemployment. So it shows that it is a benefit to adopt artificial intelligence in the workplace. This last slide here I find really fascinating. We have a case study of the browser wars in the past. I'd like to relate this to artificial intelligence, mainly with the large language models. In the early 90s, we had Mosaic, Netscape Navigator, and Microsoft Internet Explorer all reach over 90% adoption rate. And that was just in Web 1.0 in the early stages. Now, currently at the early stages of AI, we have ChatGPT that came out to a massive lead in the beginning, but right behind them we have Gemini, we have Claude, we have Grok that are gaining steam, and it's impossible to know now which one of those will end up being the winner or the best investment, but just shows how much things can change when we take a look back at history.
So I kind of want to finish up this conversation looking at what are we expecting from here? If you're in the market, or if you're thinking about getting in the market, is now even a good time? And I think that this is an interesting slide to kind of look at for some relevance in that conversation. Something that can be a definite tailwind to investing in the market and provide good returns going forward is the idea that we have significant cash on the sidelines, that with interest rates continuing to come down, the expectation that some of that is going to come back into the market, which will help push the market into a higher position. But I think it's really important to kind of look back at history, that when people have flooded their cash to the sidelines in major events, 100% of it does not come back. I mean, specifically, if you look at this following 2008, when there was a large influx of cash pushed to the sidelines, and even after that, when interest rates went to zero, you were getting no return on your cash, it didn't all come back into the market. Almost $3 trillion stayed in cash, earning nothing, not keeping up with inflation, eroding purchasing power, because people didn't feel comfortable putting it back to work after the negative event of 2008, 2009. So you can also see this again in 2020, large run up into cash on the sidelines. And even though we had some really strong market years in 2020 and 2021, it didn't all come back into the market. And even then, since then, more money has gone onto the sidelines. Now, it's important to note that a large component of ownership of this cash is likely in the baby boomer generation. Their time horizon is different. They don't have the ability or the desire to take risk with their money. If they can earn enough interest in a cash or cash equivalent that's going to maintain their purchasing power. So if we stay in this 3% interest rate environment and inflation stays just below that, there's a lot of reason why People will keep their money in a cash equivalent and not take risk in the market. Now, there will always be some, maybe younger generations who have a longer time horizon who want to take advantage of market environments. But here at Owens Estate and Wealth, we don't expect to see a large influx of cash back into the market. Certainly, we do expect some of it to come back, but I think the dynamics of the generational differences is definitely going to come into play with that. And then when you look at that of like taking cash off of the sidelines and going back into the market, we always like to remind you, investing is a marathon and not a sprint. And so, staying invested over time is a really important component. But I think that on the whole, and certainly there are exceptions to this historical frame of reference, but investing at all-time highs isn't necessarily a bad thing. So you can see from this chart that 12 months following investing on the day the market hits an all-time high generally has a slightly better performance than if you invested on any other day. Push that forward to 3 years and 5 years, and that trend line grows. There are always anomalies. I mean, we talked to clients who joined us in 2021. It was a challenging time between 21 and 23 when the market went through a correctionary period and then a subsequent recovery. But that's where keeping that marathon, not a sprint, mentality when it comes to putting your money to work in the market is really paramount. So that concludes our presentation for today. We hope that you find this information to be valuable and helpful to you. Here at Owens Estate and Wealth, we always encourage you, reach out if you have questions. We love talking about the market, the economy. We love listening to you and finding out what weighs on you or what questions that you have. But we appreciate you taking the time to spend with us today, and we hope you have a wonderful rest of your day. We look forward to seeing you again in April.